Hey everyone, and welcome. Today, we are pulling back the curtain on a trading concept that, let's be honest, the biggest players on Wall Street probably wish you didn't know about. It's a strategy they use every single day to profit from the predictable behavior of retail traders. So let's just dive right in.
Just let that sink in for a second. What if that's stop loss? The one thing you were taught to use to protect your capital. What if that's the very thing that the smart money is actively hunting? What if your safety net is actually their launchpad?
So yeah, we're about to get into a concept that really separates the sharks from the minnows in this game. It's called the liquidity trap. And I promise you, once you understand how this works, you're never going to look at a chart the same way again.
All right, so what is this thing? What exactly is a liquidity trap? What's this kind of hidden engine that seems to be pulling the market in directions you just don't expect? Let's break it down.
Okay, the easiest way to think about it is like a calculated ambush. The big players, the institutions, the whales, they deliberately push the price toward an area where they know there's a huge cluster of stop-loss orders. And their goal is to trigger this cascade of selling, which creates a massive pool of liquidity they can then use for their own benefit.
But you might be asking, why? Why go through all this trouble? I mean, why would a multi-billion-dollar hedge fund care about my tiny little stop loss? Well, the answer is actually really simple and pretty ruthless. They need your shares. Picture this, right? Let's say you're a big fund and you want to buy 1,000,000 shares of a stock. If you just go and place a giant buy order on the market, you'll send the price rocketing to the moon before you can even get your full position. So what do? Well, you get sneaky. You find a place where you know 1,000,000 shares are about to get sold automatically. You find those stop-loss clusters.
Okay, so if they're hunting for these stop losses, where are these gold mines of liquidity? Well, they're hidden in plain sight. They are in the most predictable, most textbook places imaginable. Just think for a second about where you and pretty much every other retail trader have been taught to place your stops.
Yep, they're sitting right at those obvious support and resistance levels, those clean, equal highs and equal lows. They're parked just above yesterday's high and just below yesterday's low. And of course, they're all clustered around those big, juicy, round numbers. To the smart money, these aren't safety zones, they're hunting grounds. So now that we know where the traps are usually set, let's actually dissect the anatomy of the hunt. What's so fascinating here is how the exact same pattern on a chart can be a screaming buy signal for one trader and a trap about to be sprung for another. This is where the magic really happens. A retail trader looks at the chart and sees a solid floor, a nice, strong support level. A great place to buy, right? So they buy and they place their stop loss just below it, feeling safe. But the shark, the smart money, sees something totally different. They don't see support. They see a big, juicy pool of sell orders just waiting to be triggered. So they'll nudge the price down just enough to trip all those stops, and then they swoop in and buy up everything that's being sold in a flash. Okay, let's walk through the play-by-play. First, you see the bait, those clear, tempting equal lows. Then, bam, the trap is sprung. The price dives below that level, taking out all the stops. But here is the absolute key. You look for the rejection. A long wick forms below the lows, which is a huge sign that all that selling pressure got absorbed. And then, the confirmation. A powerful, bullish candle closes back above the original support. That's your signal. The hunt is over and the real aggressive move is just getting started. Look, knowing the trap exists is already half the battle. But now, let's talk about how you can turn this knowledge into an actual weapon in your trading arsenal. How do you trade with the trap instead of getting caught in it? Here is your battle plan. It's simple, but it's powerful. Your entry is a break above the high of that big reversal candle. Your stop loss? You tuck it safely just below the low of that long wick, that liquidity grab. And your target? You should be aiming for at least a 2-to-1 risk-to-reward ratio. Because trust me, these moves can be absolutely explosive. But listen, I have to be clear. This isn't some magic bullet. It's not going to work every single time. There are definitely pitfalls to avoid and some real nuances to master. So let's talk about how to separate the high probability A+ setups from the fool's gold. Okay, 3 big mistakes to avoid. First, don't assume every single breakdown is a trap. Sometimes support is just breaking and the market wants to go lower. Second, you have to wait for that confirmation. That strong rejection candle is your green light. Don't jump the gun. And third, pay attention to volume. A real trap or real institutional move will almost always have a surge of volume behind it. So, what's the secret sauce? What really makes this work? It's a combination of 3 things: confluence, confirmation, and patience. Is the trap happening at a key level in the bigger picture trend? That's confluence. Is there a clear, powerful rejection candle? That's your confirmation. And finally, are you disciplined enough to just wait for that perfect setup to fully form? If you can nail these 3, you'll put yourself on the right side of the trade way more often. All right, here's a little insider tip for you. The most powerful, most explosive traps are almost always set at major market crossroads. A trap that forms at a major weekly support level, that's like a firecracker. A trap that happens right at the low of the London trading session, that's dynamite. Look for these high probability zones because that's where you'll find the most powerful moves. And you know what the best part is? This isn't just a stock market thing. This is a human behavior thing. You will see these traps play out in every single market, on every single time frame. From a 5-minute chart on the NIFTY index to a daily chart on gold, the principle is exactly the same. The game is the same. And that really is the essence of pure price action trading. It's about learning to read the story that the chart itself is telling you without all the noise and the clutter of a million indicators. The price and the behavior around the price is the only real truth you'll ever need. So I'm going to leave you with this question. Now that you've seen behind the curtain, now that you understand how the trap is set, you have a choice. You can keep placing your stops in all the obvious places and just be the liquidity for the big players. Or you can learn to spot these traps, wait for them, and trade right alongside the smart money. The choice is yours.